Hello, one last time for our final video on taxes and business. We have put together these videos to help you discuss and learn about how legal English operates in this sphere of tax law. Again, this is an area that's typically controlled by numbers more than arguments, but we still need to use our language to help express how those numbers work sometimes, and that's what we're talking about. In this video, we're going to talk about a hodgepodge of tax issues that don't neatly fit in any of the other videos. And so let's get started. My name is Jeff Keiser, and I'm an American lawyer that's also a legal English expert. I've been practicing for 15 years, and I've been working with people around the world to help them learn legal English in a clear, easy to understand way. And I'm really happy that you're here with me to learn about taxes. That being said, we're still talking about taxes, and nobody likes to think about taxes. I certainly have had a million clients come to me on the day before the tax deadline with nothing prepared and need help immediately. I'm not really a tax lawyer, so I usually just find them an accountant that might be able to help. But at least I'm able to help them in that way. Taxes are what they are. So today we're going to talk about a few special topics in the law. And one interesting one is whether an award that you get as a legal judgment, whether that counts as taxable income or not. And the short answer is sometimes. Because we have an international audience here, we're also going to talk about the importance of treaties when it comes to tax law. And finally, we're going to talk just a bit about the least fun part of any tax experience, the audit. So, the general rule here is that a judgment or a settlement, if you're able to negotiate one, they're taxed in the same way. So it is irrelevant whether it's from a jury or a judge or an agreement between the parties. The taxability of that recovery generally turns on the nature of the claim. What I mean by that is this is represented by the origin of the claim test. So I guess the easy way to say that is, if you are recovering for lost profits, then it's going to be a taxable event. If it was something like an inheritance where there's no wealth tax, then that recovery may be excludable from income. This is all based on where the lawsuit comes from originally. It's much more complicated than that, but generally, your recovery, whether it's settlement by a verdict or otherwise, mediation, arbitration, all of those things, if it would have otherwise been income, as in lost profits, then, and only then, would they be taxable. So the IRS, through its Internal Revenue Code and various case law decisions, have already given us answers as to the taxability of various types of recovery. So, in a commercial setting for your corporation, claims are usually based on lost profits or damage to assets. Lost profit recoveries are clearly taxable. It's akin to being paid for your work. However, if someone has damaged an asset, like your goodwill or a factory or something like that, it may not be taxable. Such recovery is only taxable to the extent that it exceeds the taxpayer's basis in the asset. Punitive damages are generally taxable. They're very difficult to obtain, but that's a different story. Even if the underlying claim would not result in a taxable award, punitive damages are usually taxable. Interest, let's say that you have an outstanding debt and you charge legal interest on the other party. That is taxable under all circumstances. What would be not taxable? Well, again, the IRS and case law gives us good answers. Physical injury. Payouts from a personal injury claim like a car accident or a wrongful death suit are tax-free. That's because it would not be considered income generally. And generally speaking, those monies have already been spent to doctors. So personal injury recoveries are non-taxable events. Similarly, emotional distress is not a taxable event, so long as they are directly related to a physical injury that you or your client sustained. Physical sickness and medical expenses are other areas of the law where when you recover based on illness or other medical expenses, you will not pay taxes on it. It's not income. Now, the caveat is that if you have already used those medical expenses as a deduction on your taxes, you will not then be able to take your reward, your award from a settlement or from court as a second tax deduction. You can't take the same deduction twice. It's kind of the rule we're getting at here. Treaties. Treaties are bilateral agreements between countries that aim to prevent double taxation of income and assets. The idea of double taxation, that if I earn income in Argentina and I have to pay taxes in the United States, I should not also have to pay taxes in Argentina. This is the aim of tax treaties, and there are so many around the world, and they're very, very similar in a lot of ways, but they each have their quirks. For example, Japan has tax treaties with more than 90 countries, including the US and most of the EU. Japan's tax treaties, much like most of them, follow the OECD Model Tax Convention. And again, the thing that we are trying to avoid more than anything is double taxation. This treaty also gives mechanisms on how we can resolve tax disputes between the countries. Importantly, these treaties also give both sides access to the respective tax authority. So the IRS will give information to Japan's version of the IRS and vice versa to make sure that there's no thievery, no fraud going on in tax filing. Similarly, the United States has tax treaties with 60 countries, including Japan and Europe. You'll note that that's a lot fewer than Japan has. And I don't know why necessarily, but that number, there's 30 countries that Japan has a treaty with that the United States doesn't. I'm sure that it's just it's more regional and more political than anything. But just like Japan, the US tax treaties follow that OECD Model Tax Convention, but there are some variations. Again, our real goal here is to eliminate the chance of double taxation. But more importantly, US treaties tend to focus on the source of income from multinational corporations. We want to make sure that these big multinational corporations are paying their fair share. There are other parts of US tax treaties that include things about withholding tax rates on income, but that's a less important part. When it comes to Europe, the tax treaty policies are very unique based on the countries. Most follow that OECD Model Tax Convention, and the EU has developed a common framework, but there are key distinctions between the countries within the EU. Again, we're looking at the elimination of double taxation and special rules for determining the taxable income of multinational corporations. You may be hearing some repetitive themes here, but that's really what we're talking about when we are looking at these treaties. We're trying to make sure that everybody's on a level playing field when it comes to not being taxed twice and the reporting rules for income outside one country's borders. So that's important. One thing the United States does that most countries don't do as expressly is the foreign earned income exclusion. And I touched on this on an earlier video, but what this does is for people like myself that don't reside in the United States, it allows me to not pay income tax on my first $108,000 of income, so long as I am paying taxes in another country. Now, my personal situation is a little bit more complicated than that. Don't worry, I'm not making anywhere near that kind of money. But this is a great device that Americans have access to, and most countries also have a similar provision in their tax law. If you think that this might apply to you, or to someone you care about, or a client, then you should look into it. It's called the Foreign Earned Income Exclusion in the United States, and will have a different kind of rule or a different name in whatever jurisdiction you're at. Now, Japan has a whole series of special taxes, and most countries have other very unique taxes. And that's why it's really important that if you are facing tax liability in a country, to speak with an accountant or a lawyer that's based there. Because there will be some very unique rules and regulations that you'll have to comply with. But in Japan, they've got what they call the blue sky tax. And it is a tax on the value of the blue sky above a building. This applies to skyscrapers and tall buildings that block the sunlight and may obstruct the view of the sky for neighbors. I do not know what that tax rate is, but I think it's an interesting concept in the law that if you somehow obstruct the view of your neighbor, you have to pay a tax. I think it's kind of nice. There's also a tax on love hotels. It's a special tax that's designed to discourage the use of these hotels while generating revenue for the government. This is one of those taxes that is a public policy decision by the government. They don't like these businesses, but they don't want to ban them either. So they put a tax on them that makes it more expensive for the consumer, more expensive to operate for the hotel itself, but you can still go there if you want. This one I liked a lot. It's the ninja tax. There's a special tax on individuals that claim to be ninja. It is not actually enforced, but it is used to promote tourism and to draw attention to a region's ninja history and culture. When I went to Kyoto, they had a ninja museum, and I went there and I loved it. Finally, there's a hole-in-the-wall tax. It's a tax on businesses that create a hole in a wall, such as a restaurant that might install a vent, or other businesses that might install windows. This is designed to ensure that businesses do not damage public property and compensate the government for any potential repairs. So that's what I mean when I say each country has their own special set of rules and regulations. It's sometimes almost funny to consider, but sometimes they make sense. So that's why it's always important to talk to a local lawyer when it comes to these special taxes that may exist in any jurisdiction. Okay, guys, that's it. That's all I've got for you. And this wraps up our fourth and final video on legal issues, legal English, in the tax law realm. Again, thanks for watching. If you have questions or concerns, reach out to us. We love feedback. We love talking to people about the information, about certain situations you may be experiencing. But most of all, I hope you have a great day, and I hope to see you soon. Thanks so much. Bye-bye.